What if the most important economic signal of 2026 is not being broadcast from Wall Street, from the Federal Reserve, or from the anxious corridors of the Treasury Department, but from a vault in Shanghai that is almost empty? What if the traders who actually move billions in real capital, the ones who never appear on television and never post on social media, are repositioning right now in ways that telegraph something the financial press has almost entirely missed? What if two of the most powerful commodity exchanges on Earth are simultaneously sending the same distress signal from opposite sides of the planet, and almost no one in the mainstream conversation is connecting those dots? What if the story that will define precious metals for the next decade is not about inflation, not about Federal Reserve policy, not about geopolitics in the conventional sense, but about an industrial reality so fundamental, so structural, so immune to the ordinary remedies of market adjustment that it has been quietly dismantling assumptions that traders held as certainties for 30 years? Those are not rhetorical questions. They are the questions that serious, data-driven market participants are asking themselves right now, in private, behind Bloomberg terminals, with real money on the line. And the answers, when you examine the actual numbers, are more consequential than almost anything else currently demanding your attention. There is a principle in careful historical analysis, one that George Will himself has applied to political institutions with characteristic precision, which holds that when the foundations of a system begin to shift, the shift is often visible in the data long before it is visible in the headlines. The data on silver in the spring and early summer of 2026 is shifting in ways that have no modern precedent. Not in degree, not in kind, in both simultaneously. And the traders at COMEX, those grizzled professionals who have seen every manner of short squeeze, every monetary policy pivot, every commodity cycle from peak to trough and back again, are not shrugging. They are moving. Quietly, deliberately, and with the particular urgency of people who understand that in commodity markets, the time to react is before the crowd notices, not after. Let us begin with China, because that is where the pressure originates. For most of the past 2 decades, China's relationship with the global silver market was one of the stabilizing assumptions underlying Western futures trading. China mined it, refined it, and exported it. A reliable portion of that refined silver flowed into London, into New York, into the network of COMEX-approved vaults that serve as the physical backbone of the world's benchmark silver price. Traders in New York could count on that pipeline. It was as dependable, in its way, as the Postal Service, routine, unexciting, and essential precisely because of its reliability. That pipeline has now, by every credible measure, effectively closed. The data from Shanghai's combined exchange vault system, encompassing both the Shanghai Futures Exchange and the Shanghai Gold Exchange, tells a story that would have seemed implausible even 3 years ago. From a combined vault inventory of roughly 5,500 metric tons, Shanghai's silver stockpiles have collapsed to levels approaching 1,100 metric tons. That is a drawdown of approximately 91%. The Shanghai Futures Exchange alone has seen silver inventories drop by 23.1% in a single week at points during this period, falling to approximately 350 metric tons, about 11.2 million ounces, with stocks collapsing at a reported rate of roughly 62.5 tons per day. These are not rounding errors. These are not seasonal adjustments. These are the numbers of a market under structural duress. Now, one might be tempted to observe, with the reflexive confidence of a commodities analyst who has seen Chinese demand misread before, that China is simply the factory of the world, that it consumes enormous quantities of industrial materials, and that a drawdown of vault stocks reflects nothing more than the ordinary rhythm of industrial procurement. That interpretation, while not entirely without merit in other circumstances, fails completely to account for what is simultaneously happening on the other side of the Pacific Ocean. Because the COMEX vaults in New York are telling the same story from a different angle. Since October of 2025, COMEX silver inventories have declined from approximately 530 million ounces to around 351 million ounces, a reduction of roughly 178 million ounces, or approximately 34% of total inventory. Measured in physical terms, that drawdown corresponds to more than 5,500 metric tons of silver leaving the COMEX vault system in just a few months. And the registered category, the silver specifically earmarked for delivery against futures contracts, the metal that professional traders rely upon when paper claims must be honored with physical substance, has slipped below 90 million ounces, a level considered a critical cushion for futures deliveries, falling consistently since October 2025, with steady, persistent outflows rather than any single dramatic event. 2 continents, 2 exchanges, 1 direction. Down. The question a serious analyst must ask is not whether this drawdown is real. The exchange data is public, verifiable, and unambiguous. The question is what is causing it, what is sustaining it, and what happens when a drawdown of this character meets the immovable force of structural industrial demand. The cause, it turns out, is not mysterious. It is sitting in plain sight in the energy transition policies of every major economy on Earth, in the solar panels multiplying across every rooftop from Shanghai to Stuttgart to Sacramento. Silver's industrial applications account for something upward of 60% of annual silver demand, driven by its extraordinary physical properties, its unmatched electrical conductivity, thermal conductivity, and reflectivity, making it irreplaceable in precisely the applications that the modern economy has decided are essential for its survival. Solar panels require silver, electric vehicles require silver, fifth-generation wireless infrastructure requires silver. The data centers processing the artificial intelligence workloads that every corporation in the developed world is now racing to deploy require silver. Military and aerospace systems. And one notes that the global defense spending environment has not recently suggested any diminishment of that category, require silver in components where substitution is not an engineering option, but an engineering impossibility. China installed more solar capacity last year than the rest of the world combined. Every gigawatt of that capacity required silver. Chinese importers in early 2026 were paying a premium of 12 to 13% above the international spot price, with silver trading above $90 locally in Shanghai. And China's silver imports in early 2026 hit their highest level in 8 years. When a nation the size of China is paying that kind of premium to secure a commodity, it is not speculating, it is procuring. The distinction matters enormously, because speculators can be scared away by price moves, by margin calls, by the ordinary turbulence of futures markets. Industrial procurers cannot. A solar panel manufacturer who needs silver paste for photovoltaic cells does not have the option of switching to a different input when the price rises. The laws of physics are not subject to the same renegotiation as procurement contracts. And this is where the silver market situation becomes genuinely unprecedented, not in the emotional sense that financial commentators apply that word to any development they find surprising, but in the precise historical sense that the combination of factors currently converging has no adequate parallel in the modern record of commodity markets. If what you've just heard stopped you in your tracks, if you realize that this story goes far deeper than anything you've seen covered in mainstream financial media, then do yourself one favor right now. Subscribe to this channel. Not because I'm asking, because the next 3 parts of this analysis will make everything you just heard look like the opening paragraph. Hit subscribe. It costs you nothing. What you learn here could matter enormously. Here is something that market veterans understand, and that casual observers almost never appreciate. The most dangerous moment in any commodity market is not when the price is collapsing. The most dangerous moment is when the price is declining while the physical fundamentals are tightening. Because what that combination tells you is that the paper market and the physical market have temporarily decoupled, and that decouplings of that character in the history of commodity exchanges have a consistent and uncomfortable tendency to resolve themselves violently, suddenly, and in the direction of physical reality rather than paper convenience. That is precisely the situation in the silver market as the summer of 2026 unfolds. Let us talk about what serious traders actually watch, because it is not the number you see scrolling across the bottom of a financial news broadcast. Silver surged 147% in 2025, one of its strongest years on record, and hit a nominal all-time high of approximately $121.64 per ounce, $121.64 per ounce in January 2026. But by the time of this analysis, silver has pulled back considerably from that peak, trading in the low 60s after what has been, in the parlance of the professional class, a meaningful correction. The casual observer, encountering that pullback, draws the obvious conclusion. The rally is over, the excitement has passed, and silver has returned to its customary role as an afterthought in the portfolio of anyone not wearing a tri-corner hat and worrying about the gold standard. The professional observer draws an entirely different conclusion, because here is what did not change during that correction: the Shanghai premium, the COMEX drawdown, the structural supply deficit, the industrial demand trajectory. The Shanghai Gold Exchange closed at approximately $95.60 per ounce, while the LBMA benchmark price was approximately $84 per ounce, a premium of $11.90 per ounce, or roughly 14.15%. Premiums of this scale indicate that domestic buyers in China are willing to pay significantly above international benchmarks to secure physical supply. A spread of that magnitude, persisting over months rather than days, is not an arbitrage opportunity waiting to be captured. It is evidence that the available supply of silver in the Western vaults is insufficient to satisfy the demand pulling from the East, and that the capital controls and logistical frictions between jurisdictions are preventing the normal equilibrating mechanism from functioning. Under ordinary market conditions, a spread of 14% between Shanghai and London is the kind of opportunity that would mobilize every bullion bank on the planet within hours. Traders would buy in New York, ship to Shanghai, collect the premium, and repeat until the gap closed. The fact that this spread has persisted, has, by some measures, been even wider at earlier points in 2026, tells you something fundamental about the physical reality of the silver market. The metal is moving east. It has been moving east for months, and it is not moving fast enough, or in sufficient quantities, to close the gap. COMEX inventories have seen 14 straight days of outflows at certain points, with more than 33.9 million ounces leaving during one particularly acute stretch. And the characterization from professional observers has been consistent. It is not the amount leaving that signals stress, it is the unidirectional, unrelenting persistence of the drain. Now let us examine what this means for the architecture of the futures market itself, because this is where the analysis becomes genuinely technical and genuinely alarming if you understand what you are looking at. As of mid-April 2026, COMEX registered silver, the metal actually available for delivery against futures contracts, stood at roughly 76.8 million ounces. Open interest on the COMEX stood at 575.5 million ounces. That is a delivery coverage ratio of just 13.4%. For every single ounce of real, deliverable silver in those vaults, there are 7.5 paper claims stacked on top of it. Pause on that number. Sit with it for a moment. 7.5 paper claims for every physical ounce available for delivery. And the trend line on the registered inventory is not horizontal. It is not stabilizing. In what was traditionally a minor delivery month, January 2026 saw COMEX process 49.4 million ounces of deliveries, up from 11.8 million ounces in January 2025 and just 6.8 million ounces in January 2024. A seven-fold increase in delivery demand in a non-major month indicates something unprecedented. Market participants front-running delivery periods, unwilling to wait for traditional major delivery months because they doubt sufficient silver will be available. When institutional traders, entities with access to the most sophisticated risk analysis available, entities whose financial survival depends on correctly reading market structure, begin front-running delivery periods out of concern that the metal will not be there when they need it, the word unprecedented is being used precisely and accurately, not for theatrical effect. The gold-silver ratio provides a secondary lens through which to examine the same phenomenon. At the January 2026 silver price peak, the gold-silver ratio compressed to approximately 50-1, a 14-year low. The 50-year historical average sits in the 65 to 70-1 range, and during active precious metals bull cycles, the ratio typically compresses toward 40 to 50-1 as silver outpaces gold. The compression from the ratio's elevated levels in late 2024, when silver was trading cheaply relative to gold, to the extreme compression at the January peak reflects in a single number the extraordinary repricing that occurred as physical reality began asserting itself against the paper market's more leisurely pricing mechanism. The cumulative deficit in the global silver market from 2021 through 2025 approaches 820 million ounces. 820 million ounces of silver consumed by the world that was never replaced by mining and recycling. That is not a number from a newsletter. That is the Silver Institute's own accounting, and it helps explain, with the clarity that only accumulated physical reality can provide, why vault drawdowns are occurring simultaneously across 3 continents, why Shanghai premiums persist at levels that should be arbitraged away but are not, and why the traders sitting behind institutional desks are reducing short positions in a market that, for decades, they treated as safely shortable. The commercial traders, the bullion banks, the producers, the hedgers, have historically been the ceiling on silver price rallies. When silver runs, they short it. That pattern repeated for 30 years with such regularity that it was treated not merely as a tendency, but as a law of commodity market behavior. The commitment of traders' reports in recent months have shown a reduction in commercial short positions. When the institutions whose profit model has depended on capping silver rallies begin reducing those shorts, they are not doing so out of sentimentality. They are doing so because sourcing physical silver to cover a short position in a delivery squeeze is becoming more expensive and more difficult than maintaining the position is worth. The short trade in silver, which was the most reliable trade in the metals complex for a generation, is becoming dangerous. And the traders who understand that are the ones currently repositioning. David Morgan, publisher of the Morgan Report, has described the current situation as the market entering its final phase, noting that historically, 90% of a bull market's move happens in the final 10% of its duration. Whether one accepts that specific formulation or not, the structural logic behind it is difficult to dismiss. Markets that have been suppressed by paper mechanisms for extended periods against an underlying physical reality that is tightening do not unwind gradually. They unwind abruptly. There is a quality to the current silver market situation that the historical record helps illuminate in ways that raw data alone cannot. Consider that in every previous silver cycle of consequence, the Hunt brothers' attempted corner in 1980, the Wall Street silver-driven volatility of 2021, the underlying dynamic was ultimately a financial phenomenon. A concentrated position, a speculative surge, a short-term dislocation that the market could resolve through the application of sufficient financial pressure in the other direction. The exchanges could raise margin requirements. The regulatory authorities could restrict buying on credit, and the crisis, such as it was, would resolve because it had been a crisis of financial positioning rather than of physical scarcity. What is happening in the silver market in 2026 cannot be resolved by raising margin requirements. It cannot be addressed by restricting speculative buying. It cannot be managed through the ordinary toolkit of exchange oversight. Because it is not a financial crisis, it is a manufacturing crisis dressed up in financial language. The global silver market has now recorded 6 consecutive years of structural supply deficit. Mine supply is contracting faster than industrial demand is falling. The deficit is expanding. And the mining industry's capacity to respond to that deficit is constrained by a timeline that makes monetary policy adjustments look like lightning by comparison. The process of bringing a new silver mine from discovery through permitting, environmental review, financing, construction, and initial production requires, under favorable circumstances, 7 to 12 years. Under the regulatory and political conditions prevailing in most of the jurisdictions where economically viable silver deposits exist, favorable circumstances is an optimistic characterization. Moreover, the structural peculiarity of silver mining, that the overwhelming majority of silver is produced not from primary silver mines, but as a byproduct of mining for copper, lead, zinc, and gold, means that the supply response to elevated silver prices is not even fully within the silver market's own control. A sustained increase in silver prices does not, by itself, incentivize the construction of new silver mines at anywhere near the pace required to close a deficit of this character. It might, marginally, incentivize some additional byproduct recovery. It will not build the mines, not in the time frame that matters. The world's largest primary silver producer, Fresnillo, cut its 2026 output guidance by 9% in January. Mine supply simply is not growing fast enough to keep pace with demand. And the demand side of this equation is not merely growing, it is accelerating across multiple vectors simultaneously in ways that compound upon each other rather than competing for market share. Solar manufacturing is accelerating. Electric vehicle production is accelerating. Fifth-generation wireless infrastructure deployment is accelerating. The build-out of artificial intelligence data center capacity is accelerating. Military and defense spending globally is accelerating. Each of these sectors requires silver. None of them has a viable substitute for the physical properties that make silver indispensable. And together, they constitute a demand profile for which the concept of demand destruction at higher prices, the economist's conventional safety valve, has limited applicability, because the industrial users are not buying silver because it is cheap. They are buying silver because they have no alternative. Morgan attributes the tension between paper and physical markets to the differing roles of the global exchanges. While COMEX is primarily a derivatives marketplace, the Shanghai market is increasingly dictated by industrial users who require the metal for production. Much of the silver in Shanghai's exchange inventory is going to be taken by somebody for the purposes of either investment or industry. That observation captures the essential asymmetry at the heart of the current situation. In New York, silver is predominantly a financial instrument. In Shanghai, it is increasingly a manufacturing input. And when those two orientations come into conflict over the same finite physical supply, the manufacturing input wins. Not because finance is powerless, but because a futures contract that cannot be delivered is ultimately worth nothing. Now let us be precise about what the data says and what it does not say. Because intellectual honesty demands the acknowledgement of uncertainty, even in a situation where the directional evidence is compelling. Silver remains a volatile asset. After hitting its all-time high of $121.64 121.64, in January 2026, silver has undergone a correction of significant magnitude, trading in the low 60s by mid-2026, a drawdown that will have tested the patience and perhaps the solvency of anyone who purchased at or near the peak with leverage. The structural case for silver does not eliminate the risk of significant price corrections along the way. It never has. Silver's volatility is not a bug of this market. It is a fundamental feature that has characterized the metal across every cycle in modern history. Anyone who tells you otherwise is either mistaken or not being honest with you. The Shanghai premium data carry some inherent imprecision when accessed from outside China, given the complexity of currency conversions, contract months, import duties, and the opacity of Chinese exchange reporting. The directional conclusion that Shanghai is pricing silver at a meaningful premium to Western benchmarks and that this premium reflects genuine physical demand stress rather than speculative positioning is supported by multiple independent institutional sources. The precise magnitude should be treated as approximate. As of early July 2026, silver has been trading above $61 per ounce, drawing support from weaker than expected employment data that has caused traders to scale back bets on Federal Reserve rate hikes, with June non-farm payrolls coming in at just 57,000 jobs, far below the 110,000 forecast. The macroeconomic environment, Fed rate expectations, inflation data, dollar strength will continue to exert influence on silver's paper price in the near term. That influence is real, but it is also, in the context of a structural supply deficit approaching 820 million cumulative ounces, a secondary consideration. There is a larger truth embedded in this situation that deserves explicit articulation, because it is the truth that the data has been building toward across every point of analysis we have examined. The modern industrial economy, the economy that runs on solar energy and electric vehicles and fifth-generation wireless networks and artificial intelligence, has built itself upon a material for which it has no substitute and which it is consuming at a rate that exceeds the planet's capacity to replace. That is not a financial problem. It is a civilizational problem dressed in financial language, expressing itself first in the vault data of obscure commodity exchanges, before it eventually expresses itself in places and ways that will be impossible to ignore. The traders sitting at COMEX terminals are not reacting to newsletter writers or social media sentiment. They are reacting to the fundamental reality that the short trade in silver, the trade that worked reliably for 30 years, is facing a physical constraint that no amount of financial engineering can permanently resolve. They are reacting to the knowledge that when 7.5 paper claims sit atop every deliverable ounce, and the deliverable ounces are declining, and the demand for physical delivery is increasing, and the supply pipeline from the world's largest refiner has narrowed to a trickle, the question is not whether the paper market and the physical market will reconcile. The question is only when, and at what price, and who is positioned correctly when it happens. The data is public. The exchange reports are published daily. The vault numbers are verifiable by anyone with an internet connection and the patience to read them carefully. What is not widely distributed is the interpretive framework, the understanding of how registered versus eligible inventory functions, how the Shanghai premium signals physical demand stress, how the gold-silver ratio's compression reflects the market's assessment of relative scarcity. That framework is what separates the institutional trader who repositions before the crowd from the retail investor who reads about it afterward. Now you have the framework. What you do with it is, properly, your own decision. Before you close this video, I want to ask you something directly. Not about silver, about this community. The analysis you've just heard, the vault data, the Shanghai premium, the delivery coverage ratio, the commercial trader repositioning, took considerable time to research, verify, and structure. If you found it valuable, if it gave you something you didn't have before, tell me what you're watching in the silver market right now. Drop it in the comments. Are you tracking the Shanghai data? Have you noticed the COMEX registered inventory decline? Have you positioned yourself based on any of this? The people who comment on this channel think more carefully about markets than almost any audience I've encountered anywhere. Your observations